if I already know the lender, but if I don't, I introduce myself a little bit. And I'll just tell them, hey, sounds like we're going to be doing conventional. They said they've got 20% to put down. She thought the interest rate was going to be around 2.75. Can you just send me a pre-approval letter or just let me know the details so that when we do find a house, I've got, all my T's crossed and I's dotted. And then hopefully they email or call you back and just tell you, oh my gosh, yes, they're absolutely approved. We're good to go. They're solid buyers. They've got enough cash. That tells you you're working with somebody who, has a little bit more flexibility, or hopefully the lender will call or email you back and say, yep, we're good. Mom and dad are actually going to give us some gift funds. So we're solid. We just need to have the gift funds in order for them to buy without selling. So I like to try to just touch base with whoever their lender's going to be so that when I do this cost sheet, I already have an idea. In fact, I like to take the lender's cost sheet and my cost sheet and see how close I got them. And that's kind of hard to do, but yeah.
Before you go to the next one, can you just do a quick summary of all the top points on this?
As far as
these are the things you got to 100% make sure that you are real clear about, and the things that are going to be variables.
I would say you absolutely have to know how much they're putting down, what kind of loan they are going to do. So are they doing conventional? Is it 3%, 5%, 10, 15, 20? Is it, most loans are 15 or 30. Most are going to be 10 or 20 down, but there are other loans out there. If they're doing FHA, they have to have a minimum of 3.5% of their own money into the house. Is that what they're going to do, or are they planning on putting more money down? I have a conversation about the earnest deposit prior to writing any contracts. I always suggest to do at least $1,000 per 100. So on a $225,000 house, I would usually recommend doing a $2,000 earnest deposit. So you want to know, do they have that kind of cash? Or if it's FHA and they only have the 3.5%, do we have to do, unfortunately, let's say a $500 earnest deposit? You just remind them it's a credit at closing, but everybody's got different situations. You'll want to know before you write a cost sheet, obviously, if you're doing home inspections, if they're doing radon, are they doing any other inspections? Because you'll want to be able to put those costs in here. I usually try to go over a sample of this with them in some way, shape, or form prior to writing an offer on a house. So a lot of times we've kind of answered the questions as we've gone on. And it's, like if they tell me, hey, we're going to look at 225 to 250, but we really don't want to go above 225 if we don't have to, I'll write the cost sheet for 225 and we'll just kind of, not to say make up taxes, but we'll just, in the area that they're looking in, we'll see kind of what generally taxes might be. And so this could be a perfect example for somebody if they said to me, I'm going to put 10% down. We could talk about inspections. We could talk about some other things and then just tell them, okay, these are the variables. It could be this or it could be that. But for the most part, you just need to know what kind of loan, how much they're going to put down, what the interest rate is, how much they're doing for an earnest deposit. And then I would say inspections. Are they doing a whole house inspection or any other inspections? Or are they, if they're wanting a warranty, but they're going to pay for it themselves, you want to make sure you know that. Those are a lot of questions that I think you go through when you kind of talk through the offer, if that makes sense. So I talk through the offer almost all the way through the purchase agreement before we sit down and do the purchase agreement.
Yeah, I think you said exactly what I was wanting, is that before you even dive into this, there's a certain amount of basic things that are going to stop you on the way to having this be smooth. So those are the things I want.
When they find that perfect house and they call up like, oh my God, Raquel, this is the one, we want to make an offer. That's when I go, okay, cool. And I get my notepad out and I sit there and I said, okay, so what are we talking about for a purchase price? This one's listed at $215 or whatever. And we know it's a competitive market. These are the buyers that everybody dreams of. And they're like, we want to offer them 10,000 over and we don't care if it appraises. Okay, cool. So you got your purchase price. And that's when I would say, okay, now I think you guys talked about 10% down. So that'd be about 22.5. Yep, we're good with that. Okay, cool. Now, home inspection, you really absolutely want to do the home inspection for informational purposes only. Doesn't matter because it's still going to cost them about $400. So these are all the questions that I'm kind of like mentally going through the purchase agreement and just answering those questions as we go through. All the way down to, okay, now tell me also, how do you guys want to take title? You guys are married. If something were to happen to one of you, the other one gets full interest in the property. Oh, yeah. So I know now I've got to write it, joint tenants with rights of survivorship, a married couple. I pretty much just kind of mentally go down the whole purchase agreement before I even do this. Okay, so in a nutshell, you just go through the closing costs. So 22.5 in this case. So I group my lender fees in two groups. One is the application credit and appraisal. And then a little ways down, you'll see loan company fees. I went through and took about 7 just random closings I've had the last year or so. All different price ranges from 190 to 515. They were all over the board. There was no consistency with any of them. And so I just took the average closing fees. I did not include any discount points or anything like that. The average closing fee that I came up with between all of them was about $1,600. They ranged from about, I think, $800 all the way up to like $2,300 or something like that. The most expensive was the couple that had gift loans. They had like an additional $500 in fees. And I'm sure that was administrative fees because there were extra things the lender had to do. That's where you really want to talk with your lender. And when I go over this cost sheet, if I don't have a cost sheet from the lender, if I have a cost sheet from the lender, sometimes they're pretty straightforward and those are easy to do. If I don't have one from the lender, I always tell my people, always refer back to your lender for these fees. I'm just going to go and give you kind of averages and estimates. But I do like to estimate a little high. I would rather have you think you're bringing $700 for that and have it only be $550. And they get it. They understand. But I always tell them on these fees, you always want to refer back to your lender because each bank is different. Each mortgage broker is different. Some of them charge. So there's fees they can charge like processing fee, underwriting fee, tax service fee, closing fee, document preparation fee. It doesn't mean they're going to charge all of these, but it just depends on the company. US Bank seems to have a lot of little fees. Some of the credit unions don't seem to have a lot of fees. Again, that's where you just have to have that communication and that relationship with the lender and find out what's going on. If you do see something though, that is, in my opinion, higher than say $1,600 or $1,700 in loan company fees, not recording fees, not title insurance, not discount points. Discount points are usually something that they choose to do to buy the loan down. But if you see something that's higher than I'd say $1,600 or $1,700 on average, and you're questioning the lender, you don't know who the mortgage broker is or the bank, you may want to have them contact, like Dundee Bank or another reputable person that you work with to say, hey, look, let's at least compare what your fees are, because sometimes it's not just the interest rate, it's about the closing fees. So keep that in mind. I found the appraisals. My appraisals, let's see if I have it on the sheet. Yeah, they were anywhere from $475 to $600. And all of mine were conventional. I had no FHA loans. One of them was even new construction, which was $600, which I'm not sure what, they had some other fees on there. But so if your appraisal runs, most of them, do you guys all have, there's a sheet, and I'll show you here in a second, that Dundee Bank put out that has a bunch of different, can you see my screen? Can you see me, or do you just see the PDF? Can you see that? No, I'll show it to you in a little bit. Dundee Bank has one put out that has a bunch of like estimated fees on it, which is a really, really, really good thing to refer to. And I'll show that to you guys in a little bit. But in a nutshell, I would estimate the appraisal to be around $500. Your credit reports are probably going to be, I have them anywhere from $50 to $80, but I would probably estimate on average 50 to 75. And then an application fee can be anywhere from $50 to $100. Again, just all depends on your lender. Surveys and termite inspections usually run 85 to 90. I just put them in there at 100. Keep in mind if they're going to do a full-blown survey. So the survey that a lender might require, which a lot of them are not requiring it anymore. And so I just make a comment that it's, we'll waive it if it's not required by the lender, unless the buyer really wants to have it done. That will just pick up. So in a typical residential plot, you have 4 pins, 2 in front and 2 in back. It'll pick up 1 in front and 1 in back, and then they make a square out of it. If they want a full-blown boundary survey, which will pull up all 4 pins, it'll find all the pins on the property. That's something that if they are going to be putting in a fence right away, you might want to have them do a full-blown boundary survey. If it's an older neighborhood, there's already a fence and there's no question, you may just need to waive the survey, but that's going to be a lender requirement. If the lender requires a plot plan to be done, it would only run about $85. So again, I'm estimating a little higher. Termite inspection, same thing. If they're doing a whole house inspection, that usually will run on average about 400. Most of them are a little less than that, but for a house that's 2,500 square feet, 400 is a good estimate. If they're going to do radon or any other inspections, make sure you put that in there. Radon's probably 100. If they're doing sewer line, mold, specific inspections, add that in there. To record at the courthouse is about 100. Your half of title insurance, your closing fee, and then back down to the loan company fees. That's again where I tell them, this could be anything from a processing fee, underwriting fee, whatever it might be. Again, we're going to refer to your lender for those specific fees. And that's where it's good to know what you're looking for, because if you get the lender's cost sheet and you see exactly what they're charging, you can go through and just make sure it's all okay. They're going to break theirs out a little bit more. If you know they're paying discount points, you can put that in here. A lot of times my buyers don't even know they're paying discount points until they decide to do it last minute. Personally, I caution people from paying discount points unless they have to, because a lot of times you'll pay a percentage of the loan to buy the rate down. But you got to ask yourself, how long is it going to take to recoup that back? It just depends. It all depends. How much they're paying for it, how long it's going to be, how much the rate is being bought down. Sometimes it makes sense, sometimes it doesn't. So that's just, again, where you become that resource for your buyer, and you just help them make the best decision for them, or at least give them the information so that they can make the best decision for themselves.
Which also opens the conversation for how long they plan on staying in this house.
Mm-hmm.
Is it a military family is going to be 2-3 years? Is it a job transfer that they're anticipating? And so yeah, that's good. And
that's a perfect example. If you know you're only going to be here for 2 or 3 years and it's going to take you 7 years to recoup that discount point, you're better off taking the higher rate and just making an extra $50 or $100 a month on your payment. So that's all stuff that you can figure out. If anybody ever needs help with that, don't hesitate to call. I'll be more than happy to help you figure out. Like Kim Bills always says, I'm kind of a geek when it comes to spreadsheets and figuring things out. Like I love to sit there, like we just refinanced and I'm like, do you know that we can whatever, and for an extra whatever, and we can have this paid off? I mean, this spreadsheet was just like, it was amazing. I'm going to get it framed and put it over the fireplace. So I love to figure that kind of stuff out and like try to figure out what's best for someone, because sometimes something looks good up front. And honest to God, you guys, at the end of the day, if someone's paying an extra $1,000 and they're putting 20% down, for example, it's not going to make or break anything. If they're happy, let it be. But just let people know that you're there for them as a resource. So the other thing is with the closing costs, don't forget your broker fee. I do like $100 miscellaneous. Your flood certifications, like $19. If they wire transfer their funds, it's probably $25 or $50. Just little stuff like that as a buffer. So I always tell people, okay, your closing costs in this case are going to be $26,150. Then we get to set up your prepaids and your escrow. I go, that's the fun part. That's where we get the gold card out. You're going to do your first year of homeowners insurance. A lot of times what you'll hear people say is we need the insurance binder. When I first started, I swear to God, I don't even have a binder. I swear to God, I thought it was like a 3-ring binder that my buyer was going to get. It's a piece of paper. It's just a piece of paper that simply states that, yes, they've got insurance on the property. Even though it's paid up front, the buyer pays it at closing. 9 times out of 10. I haven't seen anybody pay it outside of closing in years. So they pay the first year of homeowners insurance. Now remember, insurance is paid once a year based upon when they buy the house. So if you buy the house in, March, your next payment is going to be due March of 22. So here comes the fun part. You close on the house in March, so you do not have a payment in April. So what happens next March when your insurance is due? You didn't start adding to your escrow account until May, which means March rolls around and now you're 2 months behind on insurance because you've really only been collecting and adding to your escrow for 10 months, if that makes sense. So what you're doing with putting in 3 months of insurance escrow is you're adding to the escrow account. So when that comes due in 1 year, you'll have a full 12 months for the payment, plus an extra, a little bit of a buffer. Does that make sense? And this is where people get really kind of all good. Okay. And then the taxes, same thing. So taxes, I do 8 months of taxes, and I would say almost always it's 8 months of taxes. What you're going to do, a portion of that is going to go to reimburse the seller for what they've already paid. So in this case, the seller would have already paid for April, May, and June. So we've got to reimburse them for those 3 months that they've paid for that they're not using. So out of the 8 months that we're going to put into these prepaids and escrows, 3 months of that is going to go to reimburse the seller. And you'll see that on the HUD statement or the Alta statement now. You'll see that the buyer will get charged for it, and then the seller will see 3 months of credit. The remaining 5 months in this case is going to go into your escrow account so that when taxes become due again, you'll have, remember, taxes are due January and July. If we close at the end of March, there's no payment in April. So we're only going to collect May and June. But the problem is in July, we technically have 6 months of taxes due, but only 2 months in our escrow account. So by putting money in at the time of closing, we've got 2 months that we've collected in our escrow account, in our payment. So for May and June, we made our payment, a little bit went into our escrow account, and then we put in 5 months when we first got the house. So now we've got 7 months of taxes in our escrow account and 6 are due. So that leaves us with 1 month. So we always want a buffer in the escrow account. So I always tell people, I do 8 months of taxes. A portion goes to reimburse the seller for what they've already paid. And then the rest goes into your escrow account to set up your escrow account so that when taxes are due, January and July, you'll have a full 6 months in there. And just assume taxes are paid. Don't worry about it if the seller hasn't paid taxes yet. The title company will take care of that. Any questions on taxes? I know that's where it gets really wonky. Okay, and then interest per day. Interest per day is super easy to do. You just take the amount of the loan times the interest rate. So in this case, we would take 220 or 202,500 times 2.75%. And then you want it per day. I do banker's days. That's just the way that I was taught. So I take it divided by 360. It does, 360 or 365. It's not going to matter. You're going to come close enough. This is why everybody always wants to close at the end of the month. So remember, if you close in this case on March 31st, you would bring with you 1 day of interest. If you closed on the 15th of the month, so instead of bringing $15.47, you'd bring with you an additional $232 to closing. So you own the house for 15 more days. The next month, your interest is in your payment. I don't know why they don't just put this into the payment as well, but you always bring with you the rest of that month's interest to closing. I personally don't recommend that anybody closes on the very last day of the month. I think you're better off closing at least like on the 30th, but just because usually the last day of the month is a little busier, but that's entirely up to your buyer and what they can and can't do. And, if they can close a couple of weeks beforehand, that's a perfect opportunity to, move out of one place, move into another place. clean the apartment, paint the new place, instead of moving out on Friday and having to be out of the new place on Monday. It's a lot. So I always recommend that people close in the middle of the month. But then again, if you're talking, we need to make this as inexpensive as possible, push them to the end of the month so that they don't have to worry about paying all that extra interest.
Jerry put a note in the chat that says the tax proration is for Douglas and Sarpy. If you sell in another market, they will be prorated as in arrears. You want to speak to that?
Thanks for complicating things, Dad.
Well, and then Courtney said, I was just thinking the same thing.
Yeah.
It might be worth pointing out that property taxes are different in the rest of the state and can have a huge impact on the seller. So there you go.
Yeah, if you get somebody moving to or from, let's say Blair, for example, which is Washington County, Douglas and Sarpy County, we collect in arrears, but we treat them as if they are real time. So if you call down to the courthouse is going to tell you that the previous owner is the one that owes those taxes. We treat them as if they're real time, which simplifies everything. There are a lot of counties across the country that don't do that, and they actually escrow the money that is due, and then it is up to the new owner to make those payments, which I think causes a lot of aggravation and headache. So I think it's important to know, if someone is buying in Washington County, for example, they may not technically have any taxes, if I'm saying this right, they may not have any taxes due for a while, because the taxes in Washington in arrears or ahead? I can't remember. Does anybody know? I don't have access to the chat. Let's see here.
Sure, advance.
It says, yes. So sell in Douglas County and buy in another county and you're ahead of the game. Angie, from Angie. So
Yeah.
If Angie has anything more to say on that, or you do, go ahead.
Yeah, we're pretty much all in arrears, but we treat them as if they're real time. So we just, think of it as the taxes that you're paying today are the ones that are due today, which is really not the case, but that's just how we treat them. Washington does not do that. So you actually, I think if you buy in Washington, you don't have any taxes until the next year. But if you're moving from Washington, you're going to be paying a ton of taxes there, plus taxes here. Does that make sense?
Yes.
The best thing to do is just, if you have somebody outside of Douglas or Sarpy County, just talk with the lender and or the title company, and we can figure out what county they're moving from. So Douglas and Sarpy, we're good to go. Lincoln, I can't speak to Lincoln at all, because I just don't do anything in Lincoln ever. So in a nutshell, I would just estimate 8 months of taxes. Just assume you're doing Douglas or Sarpy for the sample purposes. So then you would take your closing costs and your prepaids, and that would be the total amount due at closing would be $30,665. Now what we want to do is we want to credit the buyer for anything that they have already paid for, like the earnest deposit. In this case, we suggested a $2,000 earnest deposit, and they were good with that. We've already paid for the home inspection at the time of the inspection, so that has already been paid for. And then for the sample purposes, I went ahead and said, hey, the seller decided to go ahead and contribute 3% of the purchase price towards closing costs. So that's where I would put the seller paid closing costs. If I knew that mom and dad were going to be giving us, let's say, a $10,000 gift, I might go ahead and put that right here in the credits as well. And again, because mine's an Excel spreadsheet, I would just add a line and just say parent contribution, whatever it is, $10,000, because that's $10,000 less that they would need to bring with them to closing. I don't think, though, that it's imperative to put the gift in here necessarily. And the only reason being is because that is money that they're bringing with them to closing. It's just money that's being gifted to them. So it's no different than saying, we've got $10,000 in our savings account and we're going to get the other $11,000 from our retirement funds. It's kind of the same thing. At the end of the day, it's money they're bringing with them to closing. It just happens to be that mom and dad are going to be providing a portion of that. It's good to put it in there, but I think if you don't know about it, that's something that the lender would have a conversation with them about. And it doesn't change the amount due. It's just coming from different sources, if that makes sense. But again, I think the more complete picture that you can give a buyer, the easier they rest at night. And then when, changes come up, you can talk and say, oh, well, remember we talked about that. You guys were going to get the gift from mom and dad. And they say, oh, that's right, because we decided not to do that. That's why we have to bring X number of dollars, so it's, again, it's all about communication and, trying to get as much of the big picture as you can. And then I just put down there at the bottom, I put, the principal and interest. Does everybody know how to get principal and interest? Everyone has like the Carl's mortgage calculator on your phone. You can go out to Bankrate, you can get the principal and interest that way. If you don't have like a mortgage calculator on your phone, like stop what you're doing and add one. Carl's with a K is probably one of the best, or at least it's the one I've used for years. I love it. Your taxes, your insurance, and then remember, because they're not putting 20% down, they have to do a monthly PMI. The PMI factor, and I'll show you how I got this in a second. The PMI factor for this with 10% down is 0.0046. So kind of the same thing as your interest. I've taken the loan amount times 0.0046. If it's a 30-year mortgage, obviously factors are lower on 15-year mortgages. And then you just figure out what it is per month. And in this case, they're paying $77 a month for mortgage insurance. On a conventional loan, once they reach 80% or 20% of equity in the home, once they reach that 20%, we can get rid of the mortgage insurance. But the key thing is they're probably going to have a new appraisal done, or at least enough time has passed, like a significant amount of time. Do not, remind your buyers, do not decide that in 3 years you've got 20% equity and you go out and get your own appraisal. Make sure that they contact the lender and tell the lender that they believe that they've got more than 20% equity, and then the lender can decide what their policy is. They might have some kind of an internal thing that they do. In a nutshell, it's probably going to cost them $500 to $800 minimum to get that monthly PI off of there, or MI off of there. But that's a lot cheaper than continuing to pay $70 a month. So just the cost of not putting 20% down. If they have your PMI on FHA, which if we have time, we can go over just the differences on FHA. If we have the private mortgage insurance for FHA is for the life of the loan. So conventional, it can be removed after you've got 20%. FHA, the mortgage insurance is for the life of the loan. And then I'll tell you really quick this, and I'm sorry, I thought I had this up on my screen, but I'm on a different computer. Do you guys all have a copy of this? I think I included it. This is something that's been going around for a few years, but it'll show you, that's how I figured out the mortgage insurance factor. And then the best part is, here's an estimation of costs with Dundee Bank. And it'll at least give you a ballpark. If you don't have it all, I mean, I know.
We got it. I got it. It was attached to the rest of the documents that you sent.
Good,
so
good.
That was really good. Yeah.
So that's really good. I pretty much just use it for the mortgage insurance factor, but don't forget it. If they're only putting 5, 10, 15% down on a conventional, do not forget that mortgage insurance. Or if there's an HOA each month, you want to make sure that you put in that monthly HOA fee.
And Paulina pointed out that the new Green Title app has calculators.
Yes, it does. It does. I totally forgot about that. Yeah.
Have you used those? Do they work for you? Or you're still on, you're good with your other one. Okay.
In fact, they have a new calculator on the DRI, and I'm like, no, take me to the old one. I just want the basic information. I don't
know. You said Carl's is the.
Oh, here, I'll show you what I have.
The one you use, because I use various ones. So
this one right, where's that little black one?
Yeah.
I use Carl's mortgage calculator, and then
KARLS.
Yeah. And I can do, it'll do all kinds of stuff. I mean, okay, let's see here. 2.75. I can do down payments. I can put a specific amount of down payment. So there's my principal and interest. And then the cool thing is, you can quickly change. Well, what if we did put, $30,000 down, which isn't quite 15%. You can put that in here.
I think simple is what most of us are looking for.
The what?
Simple.
Yeah.
Quick, simple, accessible, memorable.
Takes 2 seconds.
Yeah, fantastic.
Yeah, I love it.
Good tip.
Yeah, so, and you can backtrack it too. If someone says, well, wait a minute, I want my payment to be no more than $950. The first question you ask is, do you want your principal and interest to be no more than $950, or does that include tax and insurance? Because if $950 includes tax and insurance, you're talking about a completely different house. So again, those are just questions that you ask your buyer to find out and make sure that you're asking asking and answering the same questions. Does that make sense?
Yes.
Yeah. What questions, and if you want, I've got an FHA one, and I'll just show you the differences if you want, because pretty much a lot of it's the same. If you have questions, just holler out. Otherwise, the FHA one. So let's say it was the same house and we're doing FHA. The biggest difference is with FHA, you as a buyer have to have a minimum of 3.5% of your own money into the loan. So the seller can pay up to 6% of closing costs, which is fine. But if you really look at it, 6% plus you having to have 3.5%, they may not be able to get the full 6%. So, and this is on both sides of the fence. And side note, if a buyer is asking for closing costs, 3%, no big deal. Anything more than 3% though, most of that's going to be with taxes and your insurance. But if for some reason they start asking for 6%, or like VA, I want to say VA now, I think they can ask for the whole amount. Sorry, cat just knocked over a whole thing. You want to make sure if you're on the selling side of things, that if they're asking for 6%, is there really going to be 6% of fees? If there's not, you want to make sure that they write it as up to 6%, simply because you don't want to give them money towards something else. You want to make sure that it's just up to that percentage. On the buying side, write it however you want. And if the seller catches it, great. I've actually gone in cases and said to include things like the home inspection, re-inspection fees for the appraisal, anything that you can think of so you can make sure you get that full percentage amount. But at the end of the day, if it's FHA, they have to have a minimum of 3.5% of their own money into the loan. And then what you do, so we're going to assume that the rate is the same. If the purchase price is $225,000, the buyer has 3.5% of their own money, which is $78,755. That means the loan amount is $217,125 at a 2.75 interest rate. But on FHA, they have a funding fee, which is 1.75% of the loan. And that is just added into the loan. And now you have a new loan amount. So 1.75 of 217,125. So we've taken the loan amount, taken 1.75% of that and added it back in. Our new loan amount is $229,24. Taxes are the same, closing date's the same. Your down payment obviously is the 3.5%. For the most part, your closing costs are the same. I know on the Dundee Bank one, they have the appraisal at $525 for FHA and conventional is like $450. But again, I'm seeing them kind of all over the board, but FHA appraisals are a little bit more expensive. You may or may not want to include in your closing fees a reinspection fee. If the FHA appraiser says, hey, the value is good, but you've got to paint that back window or the side of the garage, or you need to add a hand railing, God forbid they have to add a hand railing to an upstairs attic, because it's going to cost your buyer $125 for that inspector or that appraiser to go back out to make sure the hand railing was put up or that the painting was done. So keep in mind that even though you're paying $525 for the appraisal, it could be an additional 125 if they find repairs and have to go back. So that's important that if you do have an FHA buyer, that you've really looked the house over and do you really think it can go FHA? Most houses can, but just know that, if it can't, you need to have that conversation with your buyer. So again, closing costs are about the same. Your prepaids and stuff are, relatively about the same. You've got all the same kinds of fees and stuff. In this particular case, I did an example down below. I highlighted it. Let's say you ask the seller to pay 4%. We're not going to ask them for the full 6%. We're just going to ask them for 4%. So again, there's our credit for the earnest deposit. There's our home inspection that we paid at the time of the inspection. And then there is the seller cost that they're giving to us. As long as we have 3.5% of the purchase price into it, we have to have a minimum of 3.5%. If there's any other closing costs after that, the seller could pay it. We're asking them to pay $9,000, which means at closing, we only need to bring the $4,642. And I haven't calculated that that's actually, you'd have to make sure that your people have 3.5%, but that should still be good. And then principal and interest, taxes and insurance, and then the same thing. You've got your monthly mortgage insurance, which I get from the factor. Same piece of paper that Dundee Bank provided. Just at the bottom, you'll see the FHA one. Just remember, this $156 additional that they are paying for this loan is for the life of the loan. So hopefully at some point they will refinance, maybe 5 years down the road. But if they keep this loan for 30 years, they are going to be paying $156 additional each month. So that is the exciting world of cost sheets. That's it, just kind of in the nuts and bolts. I think the biggest thing you can do, honestly, is I'll be more than happy to bore you. I bored Kathy with one. And yeah, we've gone over a couple of them. She got thrown into the lava pits and had to do one that way. And then we went over one again this week. For the most part, it's all the same thing. It's just, just remember, if you're doing FHA, it's 3.5% of their own money, and you've got your mortgage insurance. VA, if you know what the VA funding fee is, you can put that in there. A lot of times with VA, I do it like a more traditional, conventional cost sheet. And then I talk to them about referring to their lender, because you don't know what their VA has. They have different funding fees, or not funding fees. What's the word?
Allowances. Things that can and can't be paid by buyers and sellers.
Yeah. And it depends on how much they've used of it. And I let them deal with the loan officer on that. I just do a general cost sheet, and 9 times out of 10, they're pretty savvy. They get it. Or at the very least, just get a cost sheet from that lender and have your buyers sign that one. But again, you want to go over it and make sure. With VA, you're pretty set, because those are all pretty set fees. But at the end of the day, if you have any questions, call me. There's a lot of agents in the company that'll help out, or just call the lender and just say, hey, can you, I've had to go through and went, hey, why are you guys only collecting? I had one time, they only collected 1 month of insurance, and they only collected 5 months of taxes. It was an out of town, like a small town lender. So I just told my buyers, I said, hey, I've questioned it with the lender and the title company. The title company has brought it up. You guys just need to know that you're going to have a shortfall in your escrow account in about a year to a year and a half. And sure enough, they called me and said, thank you. They'd actually been putting money away, and they had a shortfall because the lender didn't require enough to be, to start the escrow account. So they were always kind of behind until finally somebody had to ask for more money. So
just curious if she creates a new cost sheet after price negotiation. Well, you have to.
Yeah.
So
you have to give, on a purchase agreement, you have to give the seller one for the initial price and one for the final price.
For all prices that are in the, in the offering, when you're giving them, they need to have a cost sheet on the seller side too. So
yeah, so on the seller, so I think what you have to turn in though is anything in writing. So if you counter it back in writing, 215, we offered 230. You have to do one at 215. If it's in writing, 230, and the final price was 225. So you'd have 3 cost sheets there. And that's the nice thing about the Excel spreadsheet is I just change it, make sure the formulas, like the document, the state tax doc, is that what it is? transfer tax. And make sure that the commissioner changed and move on.
I think the biggest thing here, and we're going to have to wrap up here real quickly, but the biggest thing here is understand and know what the cost sheets are, and have some awareness, a lot of awareness to what's correct, what's not correct, as far as like things that are way overblown or way under estimated. So working hand in hand with the lender is absolutely number one in my mind. And I think, Raquel, you'll agree. Raquel, while you were talking, I pulled up that Carl's mortgage. Holy mackerel. I love that app. Like that even allows you to send the information that you get. It's got pie charts. It's got all so simple. I just went through like 4 different examples.
This is one that I've used. I don't know if you can see that, but that's just whatever. That shows the principal and interest. So that's when I talk to my people sometimes and I'm like, hey, your payment is $1,775 a month. You know, if you made that $2,000 each month, like this will change. You know, it's amazing.
Makes you look really smart. I like things that are easy and make me look like I'm a little bit smarter than I probably am. So yeah, I thank you for that. That was an A+ tip. So
that has saved my butt so many times. Like you said, when you look smart, when you're talking to someone and you can change on the fly, like calculations like that, trust me.
It happens just like that. I just did 3 different of my own examples and I was like, oh my gosh, this is great. So maybe after this, send out a little note that has that, again, that app. I put it in the chat down below if anybody wants to check it out, but it's a great thing to have on your phone. So, okay. Any last minute questions, comments? I know this was a lot of information and some very basic, but also a really good review for those of us that kind of just like let the process just happen and forget about the super importance of things like that can actually help you to help people to feel more comfortable. Actually, I think it confirms that they are in the right price range a lot of times. So, and with new interest rates, those things change all the time and it has to change your conversation. So, Raquel, thank you so much.
Welcome. And you guys, anybody, even if you close on a property, if you want to take your cost sheet, the lender's cost sheet, the estimated cost sheet, whatever, holler. I'll be more than happy to, just email them to me and I'll look them over and be like, yeah, no, you're right. There's like a lot of junk fees here, or why are they charging this? And sometimes it's just about asking the question so that you and your buyer both understand what's going on. And it doesn't mean that it's right or wrong. It's just, we just need to understand the situation.
Yes. And Nancy Keene just said, thank you. This was very helpful information. A whole bunch of people are saying thank you. So good information. Thank you. Thanks, Raquel.
Welcome.
Super helpful. This is going to go into the library. There's about 5-7 minutes at the beginning that I hadn't hit the record button because I was trying to not hit it before. So
so excited.
That's kind of why I wanted you to summarize at that point when I realized, oh my God, I didn't turn the record on. So
that's okay. Oh, I got you.
All right.
Well, it's so exciting. You guys have to have drinks at 4. So
yeah, thank you. And don't forget drinks with your broker at 4.
I've got to show houses. Darn it.
Oh, you do?
Yes.
Can you have drinks with your clients and your broker at the same time?
They probably wouldn't mind. Maybe I'll just bring them
Yeah.
We'll just,
hey, what the heck? It's a new world. We make the rules.
We're celebrating before we make an offer. We're so excited about this house.
Okay. Yeah. Yay. Right. Okay.
Bye, guys.
Bye, guys. Everybody have a great weekend, everything. You can get us if you need us. You know where we are.
Anytime.
Bye.